Right, and we are live. Happy Thursday. Welcome to another Lunch and Learn with Purse Strings. My name is Maggie Nielsen, and I'm a partner here at Purse Strings. We're all about providing tips, tricks, pieces of advice on how to be financially fearless. And then when you're maybe going to be a stay-at-home mom, you're planning for retirement, you're getting divorced, whatever it may be, we have top-tier financial professionals ready, willing, and able to serve you. We call those our Purse Strings approved professionals, and Melinda Wilke is one of them. And we're so excited to have her on today to talk about planning for retirement as a stay-at-home mom, because that can be very complex to do. And so we're excited to have Melinda on. She's one of our Purse Strings approved professionals, but she was also recently selected for the Forbes Best in State Top Financial Security Professionals for the second year in a row. And you have an all-female team, uh, got the 2023 Face of Financial Planning from Milwaukee Magazine. And I think you've had this, 6 years running, which is
That's right.
amazing. So besides all those wonderful, accreditations, could you tell us a little bit more about you and what you do?
Sure, you bet. So I've been running this firm for 21 years. I actually started getting into finance and numbers pretty darn early. I was actually doing my parents' business tax returns by the time I was 12 years old.
I love that.
So it's just kind of been my thing. But we specialize in retirement planning. We also specialize working with physicians and their families. That is our typical client that we work with.
Awesome. And yeah, you're in the Milwaukee area, but I know you can work across the country, correct?
That's right. We're actually a national firm. So we work with almost every state. And if for any reason we weren't licensed, we'd figure it out and get one. But we're out of the Milwaukee area, Franklin, Wisconsin.
Awesome. Yeah, so we're excited to have this conversation today. Anyone tuning in live, if you have questions along the way, throw them in the chat. We're happy to get to those. If you're watching the replay, you can put them in the comments and we'll also work on getting back to those as well. So yeah, stay-at-home moms planning for retirement. What are some common mistakes you see stay-at-home moms make when planning for retirement?
Yeah, well, some of the first mistakes are really, they're unfortunately not getting involved. So
Mm,
it's really important that they are involved in understanding who the advisor is, who's the financial advisor, making sure they have comfort with that financial advisor, and then understanding what is the plan. What's their
mhm.
plan for their whole household? And it's really critical that they have a relationship with the advisor. It doesn't matter who earns the money. Any money earned in the household, it's the people of the household that are important to be aware of what is happening and what the plan is. Some other things is that unfortunately we see a lot of stay-at-home moms not be aware of where these accounts are held, what
Mm,
type of accounts they are, what's the goal of each of these accounts. And if they ever have to take this over, that can be really scary if that's the first time they're trying to learn that information. Some of the other mistakes we see is that when people are getting married, they don't go back and review what are
mm.
account beneficiaries, what are account titles. I cannot tell you how many times we see money goes to like someone's mom or dad, and they've been
Yeah,
married for way too long, but nobody went back and fixed that. Or an ex-wife. That's not pretty.
no. Mom and
So
dad's one thing, ex-wife is another.
Yeah, yeah. Be aware of any kind of legal documents, your wills, your trusts, your power of attorneys. Make sure you have them if that's what's appropriate for you, but also understand them. What are you saying inside of that? What did you sign off on? We do see too many people that believe because they're married, by default, their spouse is their person who gets all the say about their health care and their finances if something goes wrong. That's not accurate. When you're 18 years old, you are your own voice, and you have to have that legal piece of paper
Well,
that gives that power to somebody else, even your spouse, believe it or not. Um, Other things, honestly, is crazy stuff like not having a credit card in their own name and
oh
under
yeah.
their social security number. Unfortunately, when something happens to that spouse, that social security number and those accounts go with them. And we can find, amazing ladies sitting in the grocery store and their credit card gets declined because it wasn't
Mhm.
under their social security number. And of
Yeah.
course, prioritizing. So something like retirement, prioritize that over things like kids' college.
Please, yeah. Just say that louder for everyone, just because that's so important. We see, they think they're going to get that return and somehow get that money back, and that's not how it goes. And you also didn't tell your
No,
kids that was the situation either.
you know what I tend to see after doing this for 21 years is that when kids become adults and their parents need help, for example, if a child understood this and was given a choice, would you rather have help from your parents to pay for your college? Or do you want to, if you get that, do you want to now have to be the asset that provides the money for support for your parents' retirement, and you support your parents now in retirement? Most adult kids will never choose that. They would say, no, thank you. I don't want that responsibility. I will use all the other resources, and there's many of them for kids' college. There's not resources for retirement planning and retirement assets like there is for college.
Right. Yeah, that's huge. We see that a lot, and that's, just not great. Um, but I like how you mentioned, all the money is the family's, the house money.
Sorry.
It's because I think a lot of stay-at-home moms say, well, I don't earn it, so I don't need to meet with a professional. I don't need to know about these accounts. And, you said know about the accounts, the type of investments, and those different things. And it's not something you need to just whip out of your head and know, off the bat, but it's just being familiar with it, which I like how you mentioned that, because it's not like you don't need to know everything and how it all works, but don't have this be the first time you see it when a catastrophe happens.
Right.
It's just being part of that conversation, knowing that professional. And that's why sometimes I say, that professional is almost one of the first people that's called if you die, So it's like, do you feel comfortable calling your partner's financial professional, or do you feel comfortable having your kids call them? Do you feel like they're in good hands, which I think is a great way to kind of measure your professional.
Absolutely. And we
Yeah.
tend to be one of the first people to receive that call, and it's extremely emotional. You
Mm-hmm.
are really raw when you're calling
Yeah.
that professional, and you've got to be able to be who you are when you talk to them.
Right. Yeah. So yeah, get that relationship going, be part of the conversation. Even though you're not making that income, you're saving the family a lot of money, staying at home, taking care of those kids. So how can a stay-at-home mom save for retirement without kind of that traditional job, bringing in money?
Yeah, great question. So there is what's called a spousal IRA, or it can also be a spousal Roth, that so many stay-at-home parents or people who are not earning an income are not aware of. So the same limit that person working can put in, so the $6,500 a year if you're under the age of 50, you can put that money in even if you do not have earned income, if your spouse you're married to does earn enough income for you. So let's just do a quick example. If you and your spouse both want to put in $6,500 for the year, that means that's $13,000. Your spouse has to earn at least that $13,000 to call that earned income to account for both of them.
Mm-hmm.
So it can be an IRA or it can be a Roth. And it just is going to matter what's important to your plan. Is it more important to have dollars that are taxable later on in retirement, or dollars that are going to be tax-free later in retirement? And also, it's going to matter how you want to leave your money to your children for your legacy. Do you want to leave
Okay.
them taxable dollars or tax-free dollars? That might make all the difference of which account you're choosing for that spousal IRA or that spousal Roth.
And so why would you open this versus just having your partner do like the 65,000 or 6,500 and then putting it in a different investment account for retirement? Why would you do two of the same accounts?
Yeah, great question. So when you use a retirement account, it's going to be what's called tax deferred. So between now and let's just pretend age 65 is when retirement is going to be. So between now and 65, all that growth in that account, or any dividends that spun off, or interest that spun off, it is tax deferred, or in English, no taxes are owed by you. So you won't get a tax statement and you don't pay taxes. The money stays in the account and it's growing bigger, 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 bigger. No tax yet. Then when you turn, I'm going to call it 65, only because that's a pretend retirement age. At age 65, Now, if you had an IRA or a Roth, depends which account you picked.
Mm-hmm.
If it was a Roth, as you take those dollars out, now those dollars are going to be tax free. So not only the money you put in, because it was after tax dollars if it was a Roth, but now all that growth over all these many, many years is completely tax free.
Wow.
There's also no required minimum distribution. Or I guess in English is there's no force of you taking money out at a later age in retirement. And that can, believe it or not, be a big issue for people in retirement. If it was an IRA, those dollars at the age of 65 now are taxable at your ordinary income.
Okay.
Everything, whatever you put in and whatever the growth is. So it's a difference. If I would have put that same $6,500 into a standalone investment account, as that account is spinning off something like interest or spinning off something like dividends, that dollar is taxable today while my spouse is working. And that money you have to pay income tax on it. It's not deferred till later. It's a big deal. You actually can grow more money if you left your money inside and the interest and the dividends that you received just reinvested itself and stayed in there and kept growing. You'll have more money in the account than if you had a regular investment account holding the exact same holdings.
Wow.
So typically IRAs and Roths are your first choice when you have an extra $6,500 that you can save for the year.
Interesting. Yeah, that makes sense. And it seems like not only is this money now in your name, which helps, if you got divorced or anything later, but is just financially the best option for both of you if you stay married in love forever, because like you said, it's the better investment with the way the taxes work. And so
Yes,
it's not just thinking if divorce, it's also like just financially, it's the most sound.
Well, and I hate to say it, but even more important than if there was a divorce is that if one of you needed help, medical help, you can have one spouse's assets getting used, but not the other spouse. So we'll pick on the husband because he's not here. So if it's the husband who needs the care, his assets can get used, but your assets, so that IRA or that Roth, even though it's only $6,500 a year, you might think that's not important, but that asset is protected. It's yours. You're not the person needing that health care. And that is a big trigger. And that really can save some pretty good money for a household when you had money in your name.
Yeah, that's a great point as well. And that's why it's like you have to talk to a professional, because there are all these different nuances that you don't always think of, that you're like, oh no, I see this all the time. Like, this is the way we can protect everybody in this situation.
Yeah. And then another account would be something called a rollover IRA. You're going to get those when you had an employer account before. So if you had previously been working and you had a 401k or a 403b with a previous employer and it's still sitting with that employer, you might want to consider rolling those dollars into what's called a rollover IRA. Now you're not going to technically contribute if I just keep that in a box for a second and you were doing like $6,500 to an IRA, but that rollover IRA can now get managed. You can have completely different types of holdings inside of there. You can make sure that the type of assets you have in there are working with all the other types of retirement accounts you have in the rest of your plan. You won't forget about it. We have too many people that forget about these accounts and they get lost and it's hard for them to find them. But you have to be very careful, right, when you're doing these, and always talk to a professional and understand when you have a rollover IRA, what are your rules now of doing Roths? It's different. It will change the game for you. So it's important to talk to a professional. But those type of accounts are what people can do when they're not working and their spouse has an earned income instead.
Awesome. That's great. Yeah. So we got to be saving, for our own retirement as well. So what other tips or advice do you have for stay-at-home moms?
Oh my gosh, I have too many tips.
Right.
So some other tips are things that a stay-at-home mom can also get disability insurance, even though she's not working and not earning an income. So typically you'll find limits of about $2,000 a month. That's pretty important. If it's important, the job you're doing at home, and if you weren't able to do it and you would have to now hire somebody, that disability insurance could be the money that helps pay for that person. Or that might be the money that goes and funds that $6,500 Roth because your spouse is still working too. So that's important. Another thing to think about is long-term care coverages. If you're building up assets and you have assets for retirement, you also do want to help protect them and have a different source if there is a long-term health care issue with either you or your spouse. Stay-at-home spouses, they're eligible to get these kind of things. Life insurance, we hear a lot that a stay-at-home mom or somebody who doesn't work and have earned income say, oh, I don't need life insurance on me, right? Because I don't earn money. And I always will say things like, well, let's take you out of the picture. So I kill you on paper, right? You're gone. Tell me how your husband goes to work the next day. What are things that now has to get done that he has to do that you were doing for him? And they can start listing it.
Cleaning, take care of the baby. I mean, I think what, a $200,000 job it's worth doing.
Yeah, that's what I've seen. That's the latest number.
Yeah. So you're not making money, but you're saving money. You're not putting that money out. So if you weren't there, I could see, catastrophe. Yeah.
So a stay-at-home parent is allowed to get life insurance. So the life insurance has a limit. It's typically about half of what their working person has. So that's also important to be aware of. If for some reason, when you're getting young and you're getting married, think about these things. It's so much easier to do when people are young and healthy. So if your spouse never qualified for life insurance, now it is hindering that you can't get your own life insurance.
Oh, yeah.
So pretty interesting things. The other thing we see a lot are, especially for the stay-at-home, they tend to be aware of maybe how much money is sitting in savings or checking. A lot of times they are aware of that. And when you see that there's too much money there, it's bigger than what you need. Okay? It's bigger than your emergency fund. Those extra dollars should be going into something like a money market. Sometimes even makes sense to use something like a high yield savings account. It just, again, based on your plan and your risk level. But instead of your dollars maybe earning nothing or very, very small, right now they can be earning more like 5%. And if you do something like a different type of a savings or money market, you're also taking very, very, very little risk, but now you're earning 5%. So think about, you're able to provide 5% by coming up with that idea and helping create that account, move that money. And your spouse was way too busy to even think about it because he's at work and thinking about 1,000 other things. And that's how you just create more money for the household.
Yeah, that's really smart. And that's why it's kind of so important, like you said at the beginning, is to be part of this conversation, know what the plan is. So that way you can, either talk to you and say, okay, there is more money accumulating that we don't need right now. What should we do with it? Let's get that.
Right.
Because I know the banks aren't paying anything. And so, you might as well make 5%. That adds up, year over year.
Yes, it does.
Yeah. Are there any other tips that you want to touch on that list?
Well, actually, I'd love to dive into Social Security a little bit.
Yeah, that was kind of my next question. Can stay-at-home moms even, receive Social Security benefits?
Yeah, believe it or not, they can. So your Social Security, what you receive, is going to be based on either what you have done for the workforce or what your spouse that you're married to has done. So a stay-at-home mom can receive up to half of the same Social Security benefit that her husband will receive for retirement time. Now, you also, though, want to be aware that somebody also might want to just bump up their own Social Security. So just because they're the stay-at-home mom, they might have been the big income earner. And maybe when you look at the two figures, maybe had they just added a little bit more to their Social Security benefit, they might have had actually the bigger Social Security benefit. Wow. So you want to go to socialsecurity.gov. You want to go to the website. You want to every year pull your own Social Security benefit and check to see where you're at with earning your 40 credits. So you do have to have 40 credits. You get 4 credits a year, so 10 years of working and earning money. You do have to have 40 credits to have your own Social Security benefit.
Okay.
And for some people, when they do have that, even if it's lower, we might recommend that we pull the spouse's benefit, the one who's at home, not the one working. But we might pull that one first, as young as 62, and maybe the one working is going to stay and work till 70 and have a completely different type of benefit. Yeah. But we could have pulled that stay-at-home person at 62 if they themselves didn't have 40 credits yet.
Right.
We have found many times that stay-at-homes might have like 8 years done or 9 years done, and they had no idea. They
Yeah.
just need to get one more year, and it doesn't mean you literally have to work all year. A credit is when you earn $1,640 in a year. That's one credit.
Okay. That's easy.
Yeah. And in
It's
a
pretty,
year,
I mean,
it's
it's
just
very
$500.
reasonable. Yeah.
Yep. Totally reasonable. And of course, there are also like widow's benefits. I've heard sometimes people are not aware of this. So a widow can collect Social Security at the age of 60. She does not have to wait till 62. Now, is that the right answer? I don't know, right? It's a personalized plan.
Yep.
But you can do that. Another question we do here is, what if I get divorced?
Yeah.
Am I still eligible? You do need to be married for 10 years to be able to get the ex's benefit is your benefit.
Those are some like good numbers to know, like that 40 credits or those 10 years. Because I know another professional was telling a story where someone had 39 credits, and she's like,
Yes.
like, can we retire in 3 more months because we just got to get this credit, and all your Social Security will really increase then. And so it's just being on top of these little details where it's like, if we're married for 9 years and 6 months, we're gonna stick it through 6 more months. Like,
Definitely work 6 more months.
yeah, like it's
And
worth it.
does, and that also impacts Medicare Part A. I think a lot of people
Okay.
are not aware of that. If you're yourself or your spouse who's working, if either of you have gotten your 40 credits in, then you're both eligible to get Medicare Part A for free.
Oh, I didn't know that.
Yep. And that can be costly. So if somebody worked 39, let's say somebody worked the 39 quarters and they were going to
Right.
retire, and that was the max between the two of them, that cost can be up to $506 a month for Medicare Part A. That's a big deal, and people are not aware of that.
Yeah, and that's huge. I mean, I would be like, yeah, no problem. I'll work, another quarter, but yeah, that's crazy. I
Right.
didn't realize all those domino effects that really take place when planning all of this out. And so, how can stay-at-home moms like ensure that they are financially prepared for any unexpected expenses in retirement?
So the first we'd say is have a plan. So
Yeah.
if you have a plan, then unexpected things, which will always happen, no longer become an issue. Making sure there's an emergency fund for 3 to 6 months of all your normal expenses. 6 months you have to have if you own a house.
Okay.
3 months I tend to use more for maybe somebody renting or somebody maybe just starting out professionally. The other is make sure, again, they have enough safe money for liquid and that has no rules attached. You could be any
Okay.
age to take the money out. You can use the money for anything. As you get closer to retirement, you do want to actually have somewhere between 2 to 6 years of your expenses that are not covered from a pension or Social Security. So like kind of like a guaranteed income always coming in.
Yeah.
You now have about 2 to 6 years of these type of expenses in safe money. So you got to build up to that.
Where would be like safe money? Like, I mean, I don't think we just want all that money in our bank, our bank account. So what would be like some other spots that you might store that safe money?
Yep. So safe money could be things like the money market, high yield savings. It might be your T-bills. It might be your cash value and your life insurance.
Okay.
Those could be a CD. So those are going to be safe places that you can put dollars. Be mindful of a high yield savings. It does take on more risk than people are aware of. But they tend to be more the safer places, and they don't tend to have these rules that say how old or young are you, what's the money for. Those are going to be things like those retirement type of accounts. They've got really special rules that you have to follow. And then really the other big thing that too many people don't think about is you have to pay attention to the generations around you. So think about your children. You really want to make sure your children are financially savvy. They get educated on finance. They know how to have a cash flow budget. They know how to stay within it. They know how to save for emergency. They know how to save for their own retirement. They have their own disability policy and their own life insurance policy, because in retirement, you're only thinking about your own expenses, but your kids are still your kids. Now, they might be 30 or 40 years old, but you know what? They still have emergencies. They still make mistakes. And you know who they come to first for money? Mom and dad.
They've always been a great trusted resource to go to.
That's right. And mom and dad taught them that, right?
Yep.
So now mom and dad either has to have an extra bucket of safe money in there for their own retirement for their kids' problems, or make sure your kids are truly educated on finance so that they never have to come to mom and dad. And then you also have to think about the next generation above you. So your parents, or sometimes for people, it's your grandparents as well. But when you have an older parent, 75, 80, any of that type of stuff, and they are running into medical issues, they're running into financial issues, they have nowhere to go to get extra money. They're not going to go get another job. The bank's not going to lend them extra money. They just don't have it, right? And if that's true and they haven't done their own planning, guess who they turn to?
The tables turn.
Yeah. So that's called the sandwich generation. They're getting squished in the middle by the generation older than them and the generation younger than them. It's really important to educate your children on finance, and then get nosy and get into your parents' financial business and be aware. Do they have a financial advisor? Do they have a plan? Are they both comfortable with working with that person? Otherwise, you become their safety net, and now you have to plan for that in retirement.
Yeah, that's a great point to bring up, because there's no way that you would just let your parents struggle. You know, like if you could, you would help them. But again, your bucket can only go so far. You're like, chances are you're not going to go get a new job, especially if you have health issues. So it does become almost the family's problem or solution. So you do have to work together. So I like that point about, looking up and down that family lineage and seeing, how things are working out, because just because they're 18 does not mean that they are no longer financially kind of with you, because
it would be most people really great. That was true.
And some families are, it works like that, but most of them don't. And so, that's a great point to share. I feel like you shared a ton of great information today about through Social Security and how to plan for retirement, all these different things. Is there anything that we didn't touch on that you want to make sure is shared?
Oh my gosh. Well, one other odd nugget that kind of happens for people is that they are listed as others' guardians. So other people's children who are under the age of 18, and they're listed in their will as their future guardian. Just some weird stuff happens, and they kind of like forget, right? They forget because they're thinking about their own retirement, but they might be listed as a guardian for somebody else's child who is under that age of 18. And maybe they went into retirement because all their children were over the age of 18 or done with college. But things have happened, and all of a sudden they just inherit like a 15-year-old.
Yeah, I've seen it. I've owned family. Yeah. Yep.
So be aware of those legal documents and the things you've signed, the things you've agreed to. And if that wouldn't work anymore, you've got to go tell that other family. They should really take you off as the proper guardian now, because you're not prepared for it now.
Right. And I think these are, great conversations again to like always have with your financial professional. Like, just let you know this could be a case. No one's planning on it, but I just need you to know about that. I could become a parent again, or whatever it may be, because even though you make these customized plans, they're not set in stone. We know life changes. And so every 6 months or every year, when you guys have those conversations, things do get updated and things are readjusted to go with your life. As we know, no plan is straight and linear, and we follow it to the T. And so it's just, have these conversations, be aware, and bring in your professional. Let them know it's probably not won't happen, but this is on the table, and we all need to know about that. It's a great tip.
And definitely get an advisor that you're comfortable with. Both parties need to be comfortable. There's a lot of really great advisors out there. Certainly they could reach out to us, but there's a lot out there, and find somebody you're comfortable with. And if you're not, go find somebody else. It's okay. Right. If you did not like your hairdresser, you would leave and go find another one.
I sure would.
Financial advisor is way more important in your life.
Definitely. And it's someone you got to remember in the time of crisis. They're one of the first people you call. Do you feel comfortable talking to them? And so, yeah, don't be afraid to give Melinda a call. Her email has been going through the bottom here. She's one of our Purse Strings approved professionals, so you can check her out on our site, pursestrings.co. Otherwise, we have a ton of other amazing professionals as well. But be part of the conversation. Know who your professional is. Even if you're not making the money, you still have a huge say, and you need to be protected for yourself and your retirement. And so we want to make sure you're part of the conversation and know all these great nuggets of information to stay protected. So thank you again, Melinda, for coming on today and sharing your expertise. And we'll talk to everyone again soon.
Thank you for having me. I appreciate it.
Yeah, talk to you later. Bye.
Bye-bye.